Let's really dig into this one because this is a favorite type of exam question. It's not about whether you got the right answer, but about whether you can justify it with proper documentation. The setup is, you concluded the allowance for credit losses is at the low end of a reasonable range. The question is really, what kind of documentation proves you weren't just rubber stamping management's number? Option A, client estimate. This is the lazy one-liner. It doesn't explain why it's acceptable or what you did to reach that conclusion. On exam day, treat this like the equivalent of a student saying, "because the teacher said so." It's not evidence, it's parroting management. Weak sauce. Option B, our independent model produced a range of 4.6 to 5.4%, client at 4.7%. We challenged PD/LGD assumptions, tested data, and expanded confirmations in high-risk sectors. This is the dream answer. Why? Because it checks every box auditors are supposed to hit. Independent expectation. You didn't just look at management's model, you built your own. Range logic. You show the quantitative window, 4.6 to 5.4%, and where the client's number falls inside it, 4.7 equals low, but still acceptable. Challenging assumptions. You didn't take PD, probability of default, or LGD, loss given default, at face value. You poked at them. That's skepticism. Data testing. You verified inputs were reliable, not garbage in, garbage out. Targeted procedures. You went further where risk was higher, expanded confirmations in sensitive sectors. That's how you document judgment. Evidence, rationale, response to risk. This is what regulators and reviewers drool over because it proves you didn't just guess. Option C, we followed our methodology. This is basically trust the process. The problem is, the process is only as good as how you applied it. Without showing results, assumptions, and testing, this line is meaningless. It's like telling your gym trainer, "I followed the workout plan," without showing any weights lifted or miles run. Empty. Option D, client CFO is reputable, no issues. This is the comedy option. The CFO might be brilliant, but independence means we don't rely on reputation as evidence. This is like saying, "My friend swears he studied, so I know he'll ace the exam." Nope. The AICPA loves to throw in this kind of trust the management option as a trap. Always toss it. So the right answer is B. And here's the real-world kicker. Documenting in that style isn't just exam talk. It's exactly what PCAOB inspectors and peer reviewers look for. They want to see, did you form your own expectation? Did you evaluate assumptions? Did you test the guts of the model? Did you adjust procedures when risk was higher? If the answer is yes, then your work papers pass the sniff test. Quick tip. On exam day, when you see documentation questions, if it sounds like management said so, it's wrong. If it sounds like we relied on reputation, it's wrong. If it sounds like we documented the process but not the evidence, it's wrong. If it shows our independent evidence, analysis, and risk-based procedures, it's right. Let's slow this one down and really stretch it out, because this kind of question is sneaky. We're talking about a system implementation project for a non-issuer client where the audit firm is also involved. Independence rules under the AICPA are clear. The auditor cannot assume management's responsibilities. So, which safeguard actually works? Let's pull apart each choice carefully. Option A, segregate the implementation team from the audit team. Management selects and approves all system decisions, and auditor involvement is limited to post-implementation testing. This is the golden path. Why? Because it hits every safeguard button at once. Segregation. The folks implementing the system are not the same people signing the audit opinion. No audit my own work issue. Management control. Management, not the auditor, chooses the system settings, approves user roles, and owns the decisions. Auditor role. The auditor only comes in after the system is in place and then only to audit it, not to build it. That combination is what reduces independence threats to an acceptable level. Option B, assign an experienced audit senior to coordinate the project since they already understand the client's accounting process, provided safeguards are disclosed to governance. At first glance, this one sounds efficient. After all, who knows the client better than the audit senior? But that's exactly why it's dangerous. The moment the audit team member starts coordinating the implementation, they're in management's lane. Disclosure to governance doesn't fix the fact that the auditor is making management-type decisions. Think of it like this. Just because you told the teacher you copied someone's homework doesn't make it your own work. Independence is gone here. Option C, allow the firm to configure and test the system while management formally signs off on final settings and user roles to demonstrate oversight. This one feels polished. It even drops the phrase formal sign-off, which sounds authoritative. But here's the catch. If the auditor configures and tests the system, they're doing the very work they'll later have to audit. Management signing off after the fact is like stamping approved on a cake you didn't bake. The auditor has already crossed the line into management responsibility. That's a self-review threat in full bloom. Option D, provide system implementation services but limit the scope to non-critical modules, example HR or purchasing, so that financial reporting modules are unaffected. This one sounds almost logical. We're only working on the unimportant stuff. But independence rules don't grade by module. HR, payroll, purchasing, all of these can tie back to the financial statements. Even if they didn't, the independence issue isn't about whether the module is critical. It's about whether the auditor assumed a management role. The second the firm implements any part of the client's system, independence is impaired. Calling it non-critical doesn't change the fact. So what's the verdict? The only option that truly works is A. It's the one that avoids self-review, avoids management participation, and leaves the auditor in their proper role.
Let's unpack this partner rotation rule. 1. Lead and concurring partners rotate after 5 years and observe a 5-year timeout. Yes, this is correct. For issuer audits, the lead engagement partner, the face of the audit, and the concurring or EQR partner, the second set of eyes who approves the report, both fall under the strictest rule. They can only serve 5 consecutive years on the same client, and then they have to sit out for 5 full years before they can return to that engagement. The reason is obvious. They wield the most influence over audit quality, so regulators want to keep their objectivity fresh. Think of it like coaching a basketball team. If you're the head coach, lead partner, or the assistant coach who always calls the final plays, concurring partner, you don't get to run the same team forever. After 5 seasons, you're benched for 5. 2. Other audit partners with significant roles rotate after 7 years with a 2-year timeout. This is where the trap lies. It's false. Those other audit partners include anyone who makes important decisions on the audit, such as partners leading major subsidiaries or divisions of the client. Their rule is also 5 years of service, not 7. The only difference is their timeout. They sit out for 2 years, not 5. So the test makers blend the real numbers into a Frankenstein answer. They steal the 2-year piece from the correct rule, but pair it with a fake 7 years. That's the classic distractor. Correct answer, A, 1 only. How to lock this in for exam day. Anchor on the number 5. Everyone rotates after 5 years, no exceptions. The difference is in the timeout. Lead plus concurring, 5 years on, 5 years off. Other significant partners, 5 years on, 2 years off. If you ever see 7 years in the exam choices, treat it like a neon sign that says wrong. Quick tip. Think of it as a video game with levels. Boss level, lead plus concurring, harder rule, 5-5. Mid-level players, other partners, easier rule, 5-2.
All right, let's break this one down. The setup is a non-issuer audit, so AICPA rules apply, not PCAOB, and the senior wants to lean on the client's internal audit team for work on controls. That's allowed under auditing standards, but only if the external auditor is satisfied that the internal auditors are reliable enough to contribute valid audit evidence. Now let's analyze each choice. A. Internal audit reports directly to the controller for day-to-day matters. Big red flag. Reporting to the controller, part of management who prepares the financials, undermines objectivity. Internal audit should report functionally to the audit committee or those charged with governance, not the same people whose work they're testing. This makes them less independent, so this condition would weaken reliance, not support it. B. The external auditor evaluates internal audit's objectivity and competence and the quality of their work. Bingo! This is the heart of the requirement. Before using their work, the external auditor must evaluate whether internal audit is objective, free from bias and appropriately reporting structure, competent, trained, skilled, experienced, and whether the specific work performed is sufficient and reliable. Without this, you can't lean on their work. C. Internal audit uses the same sampling software as the external auditor. This sounds nice, but it's irrelevant. Tools don't determine reliability. People, process, and oversight do. Sharing the same software doesn't magically make the evidence valid. This is a distractor. D. The internal audit plan includes all significant risks identified by the external auditor. Also tempting, but it's not the critical condition. Even if internal audit's plan overlaps with external audit risks, the external auditor cannot rely on them without first testing their objectivity, competence, and work quality. Plans alone don't prove reliability. Correct answer? B.
The external auditor evaluates internal audit's objectivity and competence and the quality of their work. Quick tip for exam day: if you see a question about relying on internal audit, look for the words objectivity, competence, and work quality. That trio is your North Star. Anything about who they report to, what software they use, or whether their plan looks complete might sound nice, but it's secondary. All right, let's stretch this one out into a full walkthrough because this is a high-yield exam area, and the question itself hides a very common trap. Look at the three statements. 1. The auditor must determine that the applicable financial reporting framework is acceptable. This is absolutely true. Think of it like this. Before you sign up to referee a game, you want to make sure the rulebook itself is legitimate. If the framework is GAAP, IFRS, or another recognized basis, you're good. If management hands you a homemade, spreadsheet GAAP that makes up its own rules, you don't accept. This is one of the first boxes an auditor checks before accepting an engagement. 2. Management must acknowledge responsibility for the financial statements and internal control relevant to their preparation. Also true. The auditor does not create or own the financial statements. Management does. What the auditor does is opine on them. That's why acceptance depends on management acknowledging responsibility, not just for preparing the statements, but also for maintaining internal controls that support those statements. Without this acknowledgement, you'd essentially be tricked into doing management's job, which immediately ruins independence. 3. The auditor must obtain a representation that no fraud exists before planning begins. This is the sneaky one. Wrong. There is never a stage where management signs a fraud-free certificate. Why? Because fraud is always a possibility, and the auditor's responsibility is to plan and test with professional skepticism. Management does provide representations about fraud later in the written representation letter near the end of the audit, but that is not a condition for acceptance. Any answer choice saying no fraud has to be repped at acceptance is a straight trap. Final answer, A, 1 and 2 only. Big picture exam reminder. Engagement acceptance boils down to 3 pillars you should always look for. 1. The framework is acceptable. Management accepts responsibility. Statements, controls, providing info. The auditor is independent and competent. Notice what's not on the list. Any guarantee from management that fraud doesn't exist. That would be like asking a teenager if they promise they'll never break curfew. You don't rely on promises. You build monitoring around the risk. Quick tip for test day. If you see words like must obtain assurance from management that fraud does not exist, circle it mentally as a red flag. That's never part of acceptance.
Fraud is always a risk, never eliminated by a representation. All right, let's tackle this one. What is an AUP engagement? An agreed upon procedures, or AUP, engagement is like when a client says, "Can you just check these 5 things we agreed on? Nothing more, nothing less." The CPA performs only the procedures the parties agreed to and reports only what was found. There's no opinion, no assurance, just a, "Here's what I did, here's what I saw." A conclusion stating inventory exists in all material respects. Nope, that sounds like an audit conclusion. AUP never gives an overall conclusion about fair presentation or existence. B, a disclaimer of opinion stating the accountant is not independent. Nope, independence is required in an AUP. So if you're not independent, you shouldn't accept the engagement in the first place. So this doesn't fit. C, a report describing procedures and findings without providing an opinion or conclusion. Yes, that's the hallmark of AUP reporting. It's very just the facts. Example, we counted 40 items, management's records showed 42, difference of 2. D, a positive assurance statement on fair presentation. Nope again, that's an audit deliverable. AUPs don't give positive or even limited assurance. The correct reporting element for AUP is C, a report describing procedures and findings without providing an opinion or conclusion. Check. Quick tip for exam day. When you see AUP, think report equals shopping list of procedures plus results. No conclusions, no opinions, no everything looks good. Just facts. All right, the scenario? A CPA's spousal equivalent is the client's controller. Independence for an attest engagement is what? Option A, not impaired if the controller does not sign the financial statements. Think about it. Independence isn't about who picks up the pen to sign. It's about the role itself. A controller is a key position. They run the accounting system, prepare the financials, and can influence how numbers are shown. Whether they sign or not doesn't matter. Standards say if your immediate family is in a key position, you're impaired. So, option A? Nope. Option B, impaired, immediate family includes a spousal equivalent in a key position. This one nails it. The AICPA code is very clear. Immediate family includes your spouse, spousal equivalent, and dependents. A controller is a textbook example of a key position. Put those two together, immediate family plus key position, and independence is automatically impaired. No ifs, no buts. This is the correct answer. Option C? Sounds tempting, right? But it's a trap. The definition of key position isn't limited to policy setting. Just being the controller with responsibility for preparing the financials is already enough. So even if they never attend a policy meeting, they're still in a key position, which means independence is impaired no matter what. So option C? Wrong. Option D, not impaired because the CPA is not the engagement partner. Another common trick. Independence rules don't only apply to the partner in charge. They apply to all covered members of the engagement team. So even if you're a staff auditor, if your spousal equivalent is the controller, you're still impaired. No hiding behind job titles. So D is out too. So where does that leave us? The right answer is B. Impaired, immediate family includes a spousal equivalent in a key position.
Exam tip? I'd whisper in your ear if I could. Whenever you see immediate family plus key position in a question, don't overthink. That combo always equals impaired. Simple rule, bright line, high yield on the exam.
All right, which commission arrangement actually complies with professional standards? Option A, commission for recommending software to an attest client, disclosed to the audit committee. This one is a straight no-go. Attest services, that means audits, reviews, and most compilations, are all about independence. Taking a commission while auditing is like being the referee of a basketball game while also betting on the score. Even if you announce it on the loudspeaker to the crowd, the conflict of interest still exists. Disclosure does not cure the problem. Option B, commission for referring a client to a financial advisor where the CPA also performs a compilation with independence impaired and disclosed. This sounds better, but it misses a key detail. Yes, compilations allow a special carve-out. If independence is already impaired, and you've disclosed that, commissions aren't automatically forbidden. But, and it's a big but, you must also disclose the commission itself in writing to the client. Since this scenario skips that written disclosure step, it fails. It's like making a sandwich and forgetting the bread. The main ingredient is missing. Option C, commission for recommending a payroll vendor to a non-attest client with written disclosure to the client. Here's the correct one. Why? Because the engagement is non-attest, maybe tax work or consulting, so independence isn't at stake. In these cases, commissions are fine, as long as the CPA is transparent with the client. And transparency means putting it in writing. This way, the client knows you're earning a commission, and they can judge your recommendation accordingly. Nothing hidden, no funny business. Option D, commission for referring assurance services to another CPA for a fee without disclosure. This one is sneaky. Referral fees are allowed in principle, but they always require disclosure. If you don't tell your client, you've broken the transparency rule. It's like getting a referral bonus for recommending a doctor to a friend, but never telling your friend you're getting paid. They deserve to know. No disclosure means no compliance. Correct answer, C, commission for recommending a payroll vendor to a non-attest client with written disclosure to the client. Easy way to remember for the exam. Attest plus commission, always prohibited. Non-attest plus commission, allowed, but only if you give written disclosure. Referral fees, also fine, but again, must be disclosed. Think of it this way. Commissions are like spices. In the wrong dish, attest work, they ruin the meal. In the right dish, non-attest, they're fine, but only if the client knows exactly what's in the recipe. Okay, future CPAs, lean in. Let's untangle this SOC 1 puzzle. First, remember the two flavors, Type 1 and Type 2. Easy way to think about it. Type 1 equals a snapshot selfie. It tells us whether the controls are suitably designed and implemented at one point in time, like taking a single picture of your house to prove the front door has a lock. Type 2 equals a time-lapse video. It covers not only the design, but also the operating effectiveness of controls, usually across 6 to 12 months. That's like showing a whole week's footage of people actually locking and unlocking the door, proving it works in real life. Now, let's test the statements. Statement 1. A Type 2 report includes the service auditor's opinion on the design and operating effectiveness of controls. Yes, absolutely true. The Type 2 is the video. It proves the lock exists, it was installed properly, and it actually kept the door secure during the whole period. So, Statement 1 passes. Statement 2. A user auditor may reduce testing of relevant controls at the user entity based solely on a Type 1 report. Nope, this is where students sometimes trip. A Type 1 is just the snapshot. It proves the control is on paper and sitting there, but it does not prove it actually worked through the year. So, as a user auditor, you cannot say, great, selfie looks good, I don't need to test controls anymore. That would be like assuming the lock worked all year because you saw one picture of it. Not enough evidence. To reduce your own testing, you need that Type 2 time-lapse. Only then can you rely on the service auditor's work. So, which one is true? Only the first. Correct answer? A, I only. Now here's how to lock it in for the exam. Say this to yourself. Type 1 equals designed. Type 2 equals designed plus worked. If you want to cut your own testing, you need evidence they worked, and that means Type 2. Quick exam tip. If the question ever asks, can a Type 1 alone support reducing testing, your default answer is no. If it says, does a Type 2 include operating effectiveness? Your default answer is yes. Easy two-part rule. So remember, selfie versus time-lapse. That's the difference between Type 1 and Type 2. And the exam loves this question because it's short, it looks easy, but it tests whether you actually know the difference. Picture this. You've been auditing the same client for, say, 15 years. The partner and the CFO are practically on first-name terms. They joke together, they talk about their kids, maybe they even share basketball scores after every game. On the surface, it looks harmless. But in the world of audit ethics, a red flag is waving. Familiarity threat. Now, let's walk through the options carefully. 1. Advocacy threat. This is when you stop being the referee and start being the player for your client, like promoting their shares, representing them in court, or lobbying on their behalf. That's not what's happening here. Long tenure isn't cheerleading, it's comfort. 2. Familiarity threat. Bingo. When you're too close to management, or you've been on the engagement so long that you start trusting them too much, your professional skepticism softens. Instead of questioning, you start nodding along. That's the heart of familiarity threat. 3. Self-review threat. That one's about marking your own homework. Imagine you helped draft the financials or design a control system, and now you're asked to audit it. That's self-review. Different animal entirely. 4. Undue influence threat. This is when management pushes you around, like threatening to switch auditors, cut fees, or delay payments unless you play nice. That's pressure, not friendship. So let's circle back. Which one best describes long-tenured partner and close relationship with management? It's clearly familiarity threat. Now, here's how to make it exam-proof. Long time, familiarity. Too friendly, familiarity. If you see close relationship, long tenure, or trust without question, your mental highlighter should glow on familiarity threat. And just to cement it, here's a quick analogy. Imagine you've had the same barber for 15 years. At first, you checked the mirror carefully after each haircut. But now, you just smile, pay, and leave, trusting they got it right. That's familiarity threat. Comfort replacing scrutiny. Correct answer, B. Familiarity threat.